Hey everybody, thanks for joining me. This is Kay back at it with a new video. The title of this video, The Reverse Mortgage. The reverse mortgage has been around for a while now. And the way it works is that if you're a homeowner and this is your residence, you can actually borrow money off of it without paying it back. Now you're probably saying, well, Kate, you got to explain that to me a little bit more. Okay, the way the reverse mortgage works is you have to be at least 62 years of age. It has to be your personal residence. And if you have equity in your residence, you can borrow off of it and never have to pay it back. Now, let's say if you have a wife, and you pass, then she don't have to pay it back. She can still live out her days in that house without having to pay back that reverse mortgage, which is a beautiful thing because you have a lot of seniors that's sitting on a lot of equity in their properties that they don't know what to do with. Because one thing I noticed about a house, it's not a liquid asset. It's not like stocks. Whereas with stocks, you don't like it, you can sell it and then you get some money, right? Whereas with a house, on the other hand, it's not that easy. If you want to, take out money on your house, you gotta do like maybe a cash refi, a line of credit, a home equity loan, any of those type of loans. But the downside to doing any of those type of loans is you have to pay it back. Now, most seniors that's retired, that's on fixed income, probably can't afford to do that route. I'm one of those people. So, I would stay away from those type of loans because if you're on a fixed income and you can't pay it, guess what? You're going to lose your house. And I've seen many seniors actually lose their house like that. They take out those refis and those equity lines of credit and they can't pay it back. So here comes the reverse mortgage. Reverse mortgage is a beautiful thing. It could be a beautiful thing. But here's the downside to the reverse mortgage. The reverse mortgage, well, let's start from the beginning. The reverse mortgage, you got to be at least 62 years of age. It's got to be your personal residence where you live, and you have to have equity in it. Okay? So you can have a mortgage on it. However, you're going to get less money because don't forget, you still owe money on it. But let's say if you own your house free and clear. And I'm going to just throw out just a basic number so everybody can understand it because I don't know what your mortgage or what your equity is in your house, your personal house. So, I can't say how much yours will be. But let's just throw a regular number out there. Let's say you have a house and it's valued at $150,000, free and clear. You don't have a mortgage, right? Now, how much could you get from the reverse mortgage people? Now, here's the shocker part. If you got a house free and clear, no mortgage, the reverse mortgage only gonna give you about $60,000. $60,000 off a $150,000 property. Now, that's not even scratching the surface. $60,000 on $150,000, so they basically giving you a third of your money. Now, out of that $60,000, you gotta tack on all the fees that's gonna incur with it too, because you got all kind of fees. The fees is gonna knock that $60,000 down too. And I was told if you do a FHA reverse mortgage, you can't take the whole 60 the first year. You have to take a percentage of it, and then the second year you can pull the rest out. But what's the downside to that? Number one, it's not a lot of money. And then two, you're charging me fees. And then three, I'm still leaving a lot of equity up there. Wouldn't it be nice if I was able to take out 80% of my equity? Now, if I took out 80%, man, I'm good. You know, I understand I got to leave a little something up there. But if I was able to take out 80%, so let's say I was able to take out like 130 off of 150, I'm good with that. You know, because this way it's going to build up over time. And then, you know, the bank will get their money back. But I guess the way the bank is trying to do it is they want to make sure they got a lot of cushion. So if I only give you a third of 150, right, that's still leaving, what, $90,000 up there. So, you know, they got more than enough to get their money back. And if it builds up over time, well, then they really got a cushion. So I get that. But if you own a home and it's a non-liquid asset, it's not really doing you a lot of good, you know, when you start getting older, because I would think, you know, you want to spend all the money you have while you're living. Yeah, you can, you know, pass it on to one of your children, right? But most of the time they have their own house. So then they'll just take your house, sell it, and then pay it towards their house or whatever they decide to do, which is cool. You know, I get that. But wouldn't it be nice if you can use that money yourself? I mean, after all, you the one put in those hard years to pay for it, to get it to where you don't have a mortgage or you got a very little mortgage. Shouldn't you be able to enjoy the fruits of your labor? I know that's what I want to do. But again, the reverse mortgage with their fees and giving you only a third of your money, is it really worth it? And I would probably say not really, you know, unless you just really need the money. Now, here's the good parts about the reverse mortgage. If you ever want to get back out of it, you can. All you have to do is just get a bank back all their money and any fees, and then you're good. You know, so that's a good thing. You know, you're not stuck in it. You know, once you sign on the dotted line, you can never pull yourself back out. Yeah, if you got the money, you can say, hey, here go your 60,000 plus whatever fees that they want to charge, and then you get your house back, which is good, you know, because then now you can do whatever you want to do. But, you know, I just think, in my opinion, that they need to up it some more. If you got $150,000 equity, they should at least give you 100 of it, you know, and charge less fees. And then you still gotta make sure that the house is in good condition, that the taxes are paid, the insurance is paid, the upkeep on the property is still good. You know, so they want to protect their investment as well. They don't want you to take out the money and then you let the house fall down. That's not the way they want to do it. So, is it a good thing? It depends on the person, I guess. You know, if you're good with only getting a third of your money, then I guess it's okay. But then, even with that third, they still gonna take some more money off the top of it. So you probably walk with maybe about $55,000 from your 60, and you still leaving up there about $90,000 plus in equity. So, yeah, I don't know if that's something I want to do, but I definitely don't want to touch like a refi, line of credit, equity loan, any of those vehicles, because you can, a senior can easily get in trouble with those type of loans. So that's all I have for you. Again, this is Kay, back at it with a new video. Take care, guys.